Hello everyone, welcome to Money 9. Today we'll talk about factor investing and we also call it smart beta investing. So what is so smart about smart beta investing? On Money Masterclass, we are joined by Anish Teli. He is managing partner and principal officer at QED Capital PMS. He will tell us all about it. So tell us, what is factor-based investing and why do we call it smart beta investing?
Hi, Aprajita. Thanks for inviting me. So, yeah, it's a very interesting topic and, it's catching up a lot nowadays. So, traditionally, we have seen investment management divided into two parts. We understand it as active beta, as active investing and passive investing. Now, there is a midway in the fray now, which takes some features of active investing and takes some features of passive investing, and that is where we've got a midway, which we called factor investing, and so we get the word beta from passive investing because beta is essentially the market, and the smart part comes from the more active part of investing. So smart beta was essentially a marketing word coined to sort of explain factor investing. We also call it active beta in some cases. So the active part again comes from active investing, and the beta part comes from the passive investing side of it.
So what do we do in factor-based investing?
Yeah. So we all understand active investing as styles. We have styles that are like somebody is a value investor, somebody is a growth investor, and there are momentum investors. So essentially, what we do in factor investing is take this style. We have a set of codified rules that we. So, for example, if somebody is a quality investor, he or she will define their metric as return on equity or return on capital employed. If somebody is a value investor, they will define their metric as price to earning or price to book or price to sales, and then they will sort of construct a portfolio based on those codified rules or numbers that they have. So there is no discretion and there is no decision to be made when you are implementing the portfolio. All the discretion and decision making goes into the portfolio construction. Whereas in active investing, it's more done on a security by security basis. We take it more on a stock to stock basis. Whereas here in factor investing, the focus is more on construction of the portfolio. So essentially, what we would do is take a portfolio and then tilt it towards a style like value or quality or momentum. So that's how it basically works.
Okay, so more about value, quality, and momentum, just to simplify it for our viewers.
Yes. So these are also the more common ones that are used by active investors. So value has been, if you are, we understand it intuitively, buying something cheap or which is valued less than the market, and we know that in the long run the valuation will revert to the mean. So, for example, if a stock is currently valued at 10 times price earning multiple, and over the long run, the valuation multiple of that stock is 15 or 16, we know that we're buying it cheap, and over the long run it will go back to 15 or 16. So that is now in factor investing, we don't know which particular stock that is. We are basically just going to rank the stocks by valuation and construct a portfolio of the 20 most relatively cheap stocks from bottom, and then every month or quarter we will again do that ranking and again rebalance. The stocks which have become expensive or rather have reverted back to the mean, they go out, and the relatively more cheaper stocks come in. It's similar with quality, where the usual metric used is return on equity or profitability. And similarly, we would take stocks that have done well, are ranked high on return on equity, say a portfolio of 20-25 stocks. And we are not saying that I will only own a particular stock because its ROE is so much. We will take a portfolio of these stocks, and we know that over a period of time, again, consistently they will perform. And the third one that we spoke about, momentum. Momentum again is a not very well used or used, but not very well explained by active investors. but it's very popular factor currently also, and it's used in factor in mutual funds overseas as well as in India now, where it's a very simple factor where you're taking the returns of the previous 6 to 12 months and ranking the stocks based on their returns. And the bet is that these stocks that have done well in the last 6 months will continue to do well in the next 6 to 12 months. So, and then again every month or quarter we rebalance, and the stocks that have not done well go out, and the stocks that have are continuing to do well, they stay in the portfolio. So that's
And,
broadly in a nutshell how it works.
and why factor investing now, and why is it gaining traction?
A great question. So in up till the 90s, most portfolio managers also did not know, before so much of computing power came in, that what were the reasons for their stocks or portfolios to do well. And even information was not so widely available as it is today. So in the 90s, it would take probably 2 or 3 days for any investor to get the balance sheet or the P&L of a company, which we are used to getting within seconds today. Everybody gets the same information at the same time. The edge that remains today is that human behavior is perhaps the enduring edge that will remain. So if you have a rules based strategy to overcome, when there is no emotion when you're executing that strategy, there is you're not. But there are again investors continue to make those mistakes systematically over a period of time, like the behavioral biases that we hear about. Also, markets are not efficient all the time. They are frequently efficient, very hard to beat. And also, there are all types of investors in the market, from people who have a time frame of a day to pension funds and endowment funds who have the time frame of decades. So they take in that much time to factor in the information that comes into the prices in the market. So that gives you a fair amount of time to sort of capture that mispricing. So if you have a rules-based strategy, you are able to do it more efficiently in today's day and age.
And give us a background. So when was the first factor based fund was launched, and how many funds are there now, and how can investors invest in it?
Yeah. So perhaps the most common factor is actually the is beta, or the market factor, which is essentially investing in a broad market fund versus an active fund. And that was launched in 1976, which is the market fund. But other more smart beta kind of funds, which we talk about, like value and quality, these have come more in the 90s, but earlier, even then, they were more in the purview of hedge funds, and they've been available to the more common, or to the more retail investors in the 2000s. So iShares is a big player in smart beta funds. AQR, headed by Cliff Asness in the US, is a big player in smart beta, which is a hedge fund converted itself into a mutual fund. In India, we have the momentum funds available, as well as momentum plus low volatility funds available. We have quality funds available. So these are gaining traction, and these a lot more I think will be launched in the next few years. But we already have these funds available in India in the last 3 or 4 years, and they are gaining a fair amount of traction. They are doing well. That's about India.
Okay, and who should invest in it? What risk appetite to have? So what sort of investors should go for such funds?
Yeah. So one of the misconceptions sometimes when you hear about factor investing, or because it's also smart beta or quantitative investing, is that it perhaps works all the time. It's not true. It works over time. It does not work all the time. So people should sort of have them as what we call a satellite allocation to their portfolio. You have a core allocation, which could be your index fund, and as a satellite allocation, which where you're taking slightly higher risk, and you want that fund for outperformance. And each of these factors also has cycles. For example, value funds sometimes do much better, post a down market or a fall. Quality do well, when there's a recession, because the people want to invest in durable businesses, which is quality businesses. So these do well during those kind of business cycles. So depending on that, you should sort of have a mix of maybe two or three factor funds. You should also see the correlation between these factors. So value and momentum are widely believed to be have the least amount of correlation. So if you have a value factor fund and a momentum factor fund, you can sort of avail of these. There also avail some PMSs are also coming up with these kind of factor funds. The benefit there is that you can besides being a rule based strategy, you can also go to cash some like what happened in March 2020. So if you were in a mutual fund kind of situation, you would have taken the drawdown along with the market. But if you were in a more in a vehicle like an AIF or a PMS where the fund manager has more leeway, there they can sort of go to cash and protect your investment and then come back as the market moves up. So yeah, there are various ways to sort of access the factor funds in India now.
But PMS and AIF have, in PMS you have to have 50 lakh minimum investment, and in AIF you have 1 crore. So normal investor, retail investor, where do they go if they have to invest in?
So for them, what we would say is go for we have the Momentum 30 Index Fund, which is launched by UTI, or there is a Quality Fund launched by SBI, and there's ICICI has a low volatility fund and something called an Alpha Low Volatility Fund, which is nothing but a combination of momentum and low volatility. And again, Aprajita, these are indexes which are maintained by the National Stock Exchange. So these are formed or follow these indexes, and these indexes actually have a longer history than the funds themselves. So we know that these factors have worked in India in real life. So there is far more confidence in these factors, and I think as the years go by, and we see that these factors will gain more mainstream. These factor funds will gain more mainstream acceptance by investors.
Right. And how to make comparisons among all available factor funds? For example, after watching this show, if people go out and they Google about it, then how do they do their research and just give them an explainer that is how you begin and that is how you can make comparisons among available funds and do their investment.
So, like I explained, these funds do not work all the time. So they're different cycles when they work. Same as active investing, value works sometimes, quality works in other cycles, business cycles, or momentum as a factor has been found to work, across cycles, and because it's by nature it churns far faster than a value strategy or a quality strategy. So even so we would say that perhaps momentum is a fairly robust factor to look for, and you can and if you have a belief that value companies are going to make a comeback versus growth companies, and you want to do it based on valuation. So growth companies today or quality companies today look fairly overvalued. So you could go in and look at a value ETF or a value index mutual fund. And the way to evaluate it is, again, the way you evaluate any other investment, you'll have to look at the risk. You have to look at the drawdowns that these could suffer during a downturn. And like I said, these are for outperformance. So these have to have like a satellite allocation, not the core allocation in your portfolio. But these are the funds which would be consistent. I would say more in terms of they're easier to choose than an active mutual fund because the rules are known upfront. The style drift or the fund manager will not change his or her way of investing during a cycle. So that way it's much more easier. The funds are smaller, so sometimes there could be if it's an ETF, then you would have to look at the liquidity. But most of these funds are now available as mutual funds also. So in that case, the liquidity is not so much of an issue. Costs are much lower. I think most of these are in the region of 40-50 basis points. So costs are also much lower. So I think these are 2-3 factors which investors could look at and decide on terms of with their investor, of course, with their advisor. What are the kind of factor funds that they would want to have in their portfolio.
Okay, and give us a global picture. So how evolved these funds are globally, and how has AUM grown in different countries, US, UK?
So US has, I think, they have gained traction far much more than rest of the world. Europe is, I would say, second. In the US, we have about $1 trillion invested in these funds. The momentum ETF called MTUM, run by iShares, is which is a division of BlackRock, that has almost about 10 to 12 billion dollars in assets under management, and that fund has also done extremely well. The rules are known to, in spite of the fact that the rules are known to everybody. They follow a particular index. So they the so so investors have moved a lot from active mutual funds to these factor funds in the US, globally. In Europe, there is Robeco, and which has these factor funds as a part of their offering. So they run almost a $300 billion book on various kinds of funds, and their most famous fund is based on a combination of value, momentum, and quality. So they believe that these three factors combined together would give good returns with far less volatility over the long run. So one could also look at these multi-factor funds. We don't have too many of those in India right now. We have a couple, like I said, alpha low volatility, but in Europe we have this combination which has also done fairly well. So the thing is, because you have value and because you have low volatility, sometimes in a very strong bull market they may underperform, but over a cycle they do much better, I would say.
Okay, and are there factor funds investing in international factor funds, the fund of fund structure? Do we have it in India?
We don't have that as of now. We have index funds which invest in, say, an S&P 500 or a Nasdaq 100, but we don't have as of now funds or any way of. I mean, the only way you could do it is by the LRS route, by directly buying ETFs abroad on these exchanges. So that is one way to access these funds and get. So if you want you want exposure to quality in US stocks, then you would have to go and buy it directly on the exchange there. Or if you want access to value in European stocks, so you would have to buy it directly as of now. So, but maybe in the future we'll have more and more innovative funds and structures where even these kind of funds may be available in India. But at this point in time, I think it's a little early. I think the Indian factor fund itself have to gain traction far more.
Factor investment lies somewhere between active investment and passive investment. It has low cost structure. You have various kind of factor funds in quality, in momentum, in value. So go out and read up more about it and start your factor-based investment. To watch more such videos, keep watching Money9. Follow us on Facebook, Twitter, and LinkedIn. Subscribe to our YouTube channel and also visit our website money9.com in Hindi and English. Thank you for joining in.